Good morning, everyone. Thank you, Professor Piga, for your introduction. So today I will be talking about the topic of tax evasion, which I decided to analyze under a microeconomic perspective, as opposed to the usual macroeconomic perspective with which we analyze tax evasion. Indeed, I wanted to analyze tax evasion as a decision-making problem under uncertainty, and I want to gauge the extent to which a classical microeconomic approach could explain the factors that play into the decision-making process of a taxpayer of whether to evade taxes or not. So let's say my broader research intent was to possibly pose a critique to the traditional microeconomic approach in analyzing decision-making processes and trying to integrate this approach with a behavioral approach, behavioral economics approach, to see if the missing answers could be provided by behavioral economics. Tax evasion appeared to me as the perfect candidate for this analysis because tax evasion is both a problem that is suitable for a microeconomic analysis. It is a problem of economic crime, so it can be modeled microeconomically as a generalized economic crime, following Becker's theory of general deterrence. But at the same time, it is a problem of public economics. Therefore, it leverages the social contract between the citizens and the state. So let's just begin with a few bearings regarding tax evasion. Tax evasion, as I was anticipating before, is a crime, so it is characterized by its illegality, and it is the act of paying less taxes than a taxpayer is lawfully required to do. And it is a big problem in Italy as well. The last available data from the Ministry of the Economy and Finance from 2017 to 2021 reports a tax gap of 96 billion euros. And in addition to this, could be interesting to point out that our propensity to evade as a country is still above the European average. The majority of the data that I reference in my dissertation is microeconomic data. So it is data that was obtained through a series of tax audits on the population. And this approach in estimating tax evasion is called a bottom-up approach. And it's one of the two approaches that we can use for the estimate of tax evasion. The other one being the macroeconomic approach, or top-down approach, by which we estimate a potential size of the tax revenue and then we compare it with the actual tax revenue. But that is for a broader approach. So let's get into the heart of my. She's also interested. Let's get into the heart of my research question. So let us first compare the prediction of tax evasion, which is embodied by the microeconomic model, and then let's consider some behavioral insights and assess whether we believe that the behavioral economics approach integrates the missing points in the macroeconomic one, or if we want to stay with the microeconomic approach. So this is the basic modelization, let's say macroeconomically speaking, of the decision of a taxpayer to evade, and it's the utility function of the taxpayer. So it is constituted by two terms. The first term is the situation in where a taxpayer evades taxes and is not audited by the tax revenue agency. And this happens with a probability of 1 minus b. The second term is the case where a taxpayer is a tax evader, but is audited by the tax revenue agency, and this happens with a probability. So the data that you see is the tax rate, which is applied to X. That is the declared income, and it is possible to prove that X is an amount that is included between 0 and W, which is instead the actual income of the taxpayer, meaning that the taxpayer evades doesn't declare some of her income. And so the tax rate applies to declared amount, while pi, which is the penalty rate, applies to the undeclared amount. So this first modelization was introduced by Allingham and Sanmo in their foundational microeconomic model of tax evasion of 1972. When we approach, let's say, this problem of tax evasion from a microeconomic perspective, as also Allingham and Sanmo state, we must lay out the assumptions on which this modelization is based, because they are what possibly we can confute in our later discussion from the behavioral side. So we assume obviously that the agent is a rational agent because we are in the realm of microeconomics, and it is a rational agent whose let's say ultimate aim is to maximize her utility, following the von Neumann axioms of utility decision making under uncertainty. Then we assume that the only decision that the taxpayer has to make is to decide how much of her income to declare, which is X. In addition, we assume that the only element of uncertainty in her decision making is given by the probability of audit, which is P. And lastly, we must assume also that societal factors play a negligible effect in the decision-making process of the taxpayer, which is what drove my research question, because in my opinion this is wrong. Okay, so let's first try to briefly describe what happens economically speaking when a taxpayer wants to evade taxes. The first element that we point out is the contribution of the Allingham and Sandmo model to the literature on microeconomic models of tax evasion, which is to prove that this model conforms to Becker's theory of general deterrence. As a matter of fact, Allingham and Sandmo perform a comparative static analysis of this model by differentiating the dependent variable, so the amount of income to declare, with respect to all the other exogenous variables, finding an unambiguous direct relationship between probability of audit and penalty and the declared amount, meaning that the more we increase sanctions and the more we increase the probability of audit, the larger the proportion of income the taxpayer will declare. So they evade less, basically. And this confirms that the optimal policy instruments for deterring economic crimes are indeed the sanctions and the increase in the likelihood of detection. We can also make some further comments by imagining that an increase in deterrence for an economic crime such as tax evasion can create other effects. For example, a change in the labor supply that the taxpayer decides to make, which in turn affects the income of the taxpayer, making income of the taxpayer, the W, an endogenous variable and not an exogenous variable. Because if we increase the deterrence variable, the cost, let's say the value of a marginal unit of work decreases, because the deterrence, the cost that the taxpayer must bear in case of audit has increased. So she can decide either to work less because of this reduced marginal cost of a marginal value of a further unit of work, or she can decide to work more to self-insure against the possible increased cost that she will have to bear in case she's audited by the tax revenue agency. Another interesting comment that we can make regards the tax rate. So what happens if we increase the tax rate? Does the taxpayer declare more or less taxes? So let's say theoretical evidence points out to two effects: a substitution effect by which the taxpayer wishes to maintain her level of wealth unvaried. So if we increase the tax rate on the amount that she declares, she must evade more to maintain her level of wealth. But at the same time, if we increase the tax rate, the taxpayer post-tax income decreases, making the taxpayer poorer. And if we assume that risk aversion decreases proportionally with income, a poorer taxpayer is more risk averse. The more income, the less risk averse; the less income, the more risk averse. So since she's more risk averse, she will evade actually less. And so there are these two, let's say, effects going in opposite directions. Actually, later it was proved by Shlomo Itzhaki in his model in 1974 that only the income effect applies, so she tends to declare less. Although, personally speaking, by comparing this result with empirical data from the IRS in the United States, the evidence seems contradictory, so we can't really draw a conclusion on this. And lastly, I would like to point out the interesting nature of the probability of detection, because the probability of detection is assumed to be known by the taxpayer. Well, actually, we don't know with what probability we will be audited by the taxpayer, or at least we can't know for certain. And so there is a lot more uncertainty that is in reality that the taxpayer faces when making her decision. Some factors that may influence our subjective perception of the probability of audit might be whether we have already been under investigation by the tax revenue agency, so this might skew our perception of whether we're going to be investigated again or not, or if we're working with a tax expert, which can increase our information and therefore allow us to have a more realistic perception of how likely am I to be evaded by the tax revenue agency, which, by the way, don't release their strategies to the public, so we don't really know how they audit. So this model tends to predict a higher level of tax evasion than measured, because the taxpayer should evade taxes basically all the time to different extents, but he should evade taxes all the time, while in reality we observe people that don't evade taxes. So we want to make the case for why people are honest, not to why people are criminals. And the answer to this is provided by the notion of tax morale. Economists agree, they have reached a consensus on identifying tax morale as the explicative variable to account for this discrepancy. Torgler actually defines tax morale as the reason why people don't cheat, as to why they cheat, which I think is really interesting. And actually Frey says that maybe the taxpayer is not a homo economicus, but rather is a homo economicus maturus, so an agent whose cost structure is much more complex than the one that we see on the board. So let us investigate what are the components of tax morale that therefore the taxpayer takes into account in her cost structure. So one interesting variable is morality, which is interesting because for an economist it's very difficult to assess the extent to which morality plays into economic decision making. We can assume that people who take morality into account undergo three types of costs, let's say. A duty, so the feeling of a person, of a citizen, of belonging to a community, and therefore the need for this person to perform her role in her community and increase social welfare. Obviously assuming that she believes that tax evasion is detrimental, because this is also another assumption that we make, that she assumes that tax evasion is detrimental to the community, then she feels a duty not to evade taxes. But other costs are, for example, guilt and shame that the taxpayer can incur. Guilt is the cost that arises when she has evaded taxes and she's not caught, while shame arises when she evades taxes and she's caught, so she is exposed to the blame of the entire community. Another important variable, in my opinion, is a political variable, which is embodied by the perception of fairness of the fiscal system. There is extensive empirical evidence. For example, there was this one experiment they conducted in the University of Colorado, where they were, the subjects were undergoing a decision-making process on whether to evade taxes or not, and some of them were told that their tax burden was heavier for no reason than the other people, and these people, therefore, who perceived their tax burden to be unfair, tended to evade the taxes more. So evasion, perception of the fairness of the fiscal system also plays an important role. Now, what is the fairest fiscal system? I personally don't have an answer, because for economists, again, the notion of fairness is a tricky notion to work with, because it's a notion that depends on perspective. Fair to whom? In regards to whom? We can adopt some principles to define if a fiscal system is equitable or not, like the ability to pay principle or the benefit principle. But in general, we don't have an answer whether we should adopt a progressive regime by tax brackets or a flat rate regime. Our fiscal system should be progressive in Italy by law, by constitution, but the way in which we achieve this progressivity is not given, so we can have different opinions about it. And lastly, I would like to point out the importance of institutional variables influencing tax morale, which in my opinion are the most important determinants of tax morale. In my dissertation, I have also inserted a section concerning cultural factors, and there is a brief case study on the impact of religiosity and culture on tax morale in Italy. But I've decided not to present it today, but just for your information, it is there. Instead, I will be talking about the quality of spending as a last variable influencing tax morale, on which there is also a brief case study on my dissertation. So institutional variables have been also analyzed extensively, empirically. Important experiments were carried out in Switzerland by comparing the levels of tax morale in different Swiss cantons, because they belong to Switzerland, but they have different levels of democratic participation, fiscal autonomy, and also trust in the government and in the courts and in the legal system. And the experiments, among which there is Torgler, Pomerane, Weckheiman, a lot of economists have carried out this analysis in Switzerland. They have proven that there is a direct relationship between democratic participation, trust in the government and in the courts, and decentralization and tax morale. So the more, let's say, the explanation is that the more people feel in control of their own, of their community, the closer the government works with the citizens, the more people's tax morale rises, because they feel a shared responsibility and they see their duty, again, as citizens, really into action. Another institutional consideration that I want to make, which is also related to what I was saying regarding trust in government, is the trustworthiness of the government itself, which is linked to factors such as the perception of the corruption of public officials, or also the effectiveness with which the government works and with which the government uses public funds. And to this, I go to specifically what is, in my opinion, the most important variable, which is the level of public expenditure and the quality of public expenditure in affecting the citizens' tax morale. It is possibly trivial, the reason for this, because it is a social contract, so we pay something and we expect something back in the form of public provision of services. So the case study that I have presented is a case study that was given to me by Dr. Sauro Moschetti from the Bank of Italy, which I met here in Global Governance, by the way. And he has given me his study regarding the connection between tax morale and public spending level in different municipalities of Italy. They have gathered this data comparing the census data and regarding tax morale and the balance sheet of the different municipalities in Italy to get data regarding quality of the public expense and the efficiency of the public expense, and they have proven that there exists a strong direct relationship between the level of public spending and tax morale, and also the, let's say, quality or the efficiency of public spending and tax morale, or rather a strong negative relationship between the inefficiency and tax morale. Also, while the one regarding fiscal autonomy appears to be weaker than the other two. In addition, they prove that in municipalities that have a low level of public spending, citizens respond more strictly in terms of tax morale to small levels of inefficiency in the public spending. Therefore, if the overall level of public spending is really low, even a small inefficiency in the public spending causes a high decrease in the tax morale. And in addition, they have proven that contrarily, in municipalities with high fiscal autonomy, the effect is the opposite. So if the government is decentralized, a small inefficiency in the public spending is not really, does not really cause a strong negative effect in reduction of tax morale from the citizens. So to me, this is enough proof to define that behavioral considerations embodied by the notion of tax morale really help us to provide a more realistic account of why people evade taxes, as opposed to just relying on the microeconomic modeling of the decision to evade. But nevertheless, the microeconomic perspective is fundamental because it lays the basis on how to treat the problem of tax evasion and the most important policy elements to deter it. Thank you very much.
Thank you, Giulia. it seems to me from what you're saying that we should then see in the world sort of two macro social economic equilibria, one a vicious circle, one a virtuous circle, where you have low tax morale and high tax evasion in some countries, and indeed that support each other, that reinforce each other. And then on the other hand, countries with high tax morale, low tax evasion, that again support each other. If that is true, these multiple equilibria are it's very difficult to comprehend how we're going to be able to reach the good equilibrium, right? What pushes the result, the one we wish for society. What idea do you have in mind regarding this?
Okay, so I must make a disclaimer first, which was also pointed out by Professor Piga in his supervising of my thesis, which is that my data is very Western-centric, so it has a very Western perspective, so we assume that people believe that tax evasion is bad, and that there is consensus that tax evasion is something to be blamed about. Well, it is not always like this in all countries, so I must recognize that this is a limit of my study. But so this brings me to my answer. Possibly wanting to make tax evasion will be considered as blameworthy. And how do we do that? In my opinion, we strengthen the institutions of the role of the central institutions. And we do that by bettering the policies of public service provision. So this is, in my opinion, the best strategy to increase tax morale. There are also strategies that directly target, let's say, the moral feeling of tax morale. So therefore, advocacy campaigns, we could promote literacy about fiscal systems and so on. But in my opinion, there is no better proof than the hard proof. So if a country is great at public service provision, and that happens when the central institutions are strong and know how to effectively manage their revenue, then these triggers can trigger the cycle. So possibly this depends also on the geographic area and on the context we're talking about.
Yeah, no, I have a curiosity. I don't know if it's my question has makes sense, but according to you, does it make sense in the macroeconomic model to include also the complexity of the fiscal system?
Yes.
Maybe that people doesn't pay taxes because they don't understand what they have to pay because it's too complex, while other systems are very simple, couple of flows. Second, I tell you both together. In the behavioral one, not only trust in the government because it can change according to different governments and politicians, but in general the level of trust in the society, let's say the social capital, we measure this, so maybe it can be incorporated.
Absolutely. So regarding the first question, yes, there are actually studies that bank your curiosity by stating that they try to prove, not always successfully, but they try to prove that an increased complexity in the fiscal system leads taxpayers to behave strangely in declaring their taxes. So there was actually this study by Emily Cross. She she was studying whether taxpayers decided to claim deductions or not to claim deductions, and this depended on the complexity of the fiscal system. So she divided the taxpayers in three different types. So there were the chilled taxpayers, she called them chilled taxpayers, who were the taxpayers who decided not to hire a tax expert to help them understand the complexity of the fiscal system and not claim the deductions. Then there were the gamblers, and they decided to claim the deduction anyway without hiring a tax expert. And then there were people who decided to hire a tax expert and then decide where to claim deductions or not. But this is just on one perspective, but in general, we have seen both an effect where complexity increases inadvertent tax evasion also sometimes, or even tax avoidance, so exploiting these complexities to avoid taxes in a legal way, so exploiting so-called loopholes in the fiscal system. But we have also seen the opposite, let's say, behavior towards more honesty, by which people that don't understand the tax system just say, okay, I'm just not gonna claim my detraction because it's easier to do so. and this has actually been proven. And the second question regarded the
social capital,
the
not only
capital.
trust in the
So also on this, I have an empirical evidence. There was this model that from 2021 that was developed by Gersani and Wintrob. They provide a modelization of trust that they equate to the value of social cohesion or social capital, and they prove that there exists a relationship between the trust that a citizen poses in the government and the trust that the government poses in the citizen, and they actually try to include this element into their modelization of tax evasion, saying that more trust creates a positive externalities and improves tax morale and reduces tax evasion. So it's
Thank you.
Thank you so much, Giulia. So this concludes our first part of the day. I want to thank you for your attention. I also want to thank the fantastic behavior of our younger generation. Really appreciate it. We are waiting for the second commission, which is dico anche in italiano, la seconda commissione è un po' più in ritardo di noi, credo che finiranno tra 5-6 minuti. Quindi immaginate che verso mezzogiorno dovremmo completare, mezzogiorno e 5 le valutazioni, quindi state qui fuori e vi chiamiamo per la proclamazione. Grazie mille.